Okay, guys, welcome to today's session. What we're going to be covering is FAC class. We'll be covering a FAC class. So what we will do, I'm going to read the scenario on FAC. I will read your scenario on FAC. We're going to do the deferred tax calculation. So it's 2 pages we're going to read. As we read through it, we will be able to identify any issues, and then we'll go about answering the actual question. Okay, so let's go and work through it. So I'm going to share my screen, and then I will read it with you. Okay, so the deferred tax calculation, it says the following is a deferred tax computation by Mr. Musa for inclusion in the financial statements. So Econ at group deferred tax calculation as at 31 December 2019 consolidated. Okay, so we have carrying amount, we have tax base, and then we have the various things. Okay, so a debit is positive, a credit is negative. Everything is in Zimbabwe. What is that? What is the WL? What does that stand for?
Zimbabwean dollar.
Is that Zimbabwe dollar? Okay. Okay, so that is a Zimbabwean dollar. Okay, so that's it's in Zimbabwe dollar thousands. Okay. So investment in all mutual shares. So we have $25,000. So it's actually $25 million, but I'm going to read it based on how they present it. So $25,000. So that carrying amount on tax base is exactly the same according to this schedule. But they're giving us a note number 1 to go read. Then we have transmission boosters, which is 126 and 80,000. Transmitter plant, which is 50,000 and 25,000. And then we have goodwill, 300 and nothing for a tax base. Trade and other receivables, we have 14 and 8,000. Cash and cash equivalents is exactly the same. Trade and other payables is exactly the same. Taxation payable, so we have a taxation payable, but that's from a tax base. Okay, tax won't have a, so that's fine. So what's important to take note, we have to have a look at note 1, 2, 3, 4, and 5, okay, and see, especially with trade and other receivables, why is there a difference with trade and other receivables generally? Trade and other receivables will be exactly the same. The only thing that will cause a difference is a provision for doubtful debts, okay? Okay, goodwill, there will be a difference because SARS don't care about goodwill. There's no goodwill from a SARS perspective, but we have goodwill from an accounting perspective. But remember, for our purposes, goodwill does not attract deferred tax. Okay. Only the impairment on goodwill would, but goodwill without impairment does not have a deferred tax implication. Okay, so just be aware of that. Okay, so you get a temporary difference. Then you have a temporary difference, which is 180 minus 128, which most likely give you that 52. And then we have times 24% tax rate, which gives you 12. Okay, so we'll see why 24%. Maybe that's just what they what's relevant in the question. So let's say that all mutual shares were acquired in 2015. Old Mutual is listed on the Zimbabwe Stock Exchange. The carrying amount is correctly at fair value. The tax base of an asset are amounts deductible for tax purposes in the future. Shares do not get a deduction for tax purposes, thus zero tax base. However, also know that there is, I also know that if there are no tax implications, the tax base must be equivalent to the tax base to the carrying amount. I'm now just confused. Okay. So if there's no tax implications, then it's correct that you won't have there won't be any deferred tax. So when there's no tax implications, the tax base is basically equal to the carrying amount. Okay, so the only thing is, how does SARS, or how does your accounting standards, how does your tax standards deal with financial instruments? Okay, so is it at fair value, is it at cost, and so forth? But generally shares will be at fair value. Okay, and as a result, there won't be any tax consequences. So what's important to take note, when you don't expect any tax consequences for an asset, and the tax base is equal to the carrying amount. So accounting is fair valuing the investment in shares. From an income tax perspective, I know you're in South Africa, from an income tax perspective, you will also fair value the shares. So because both are at fair value, there won't be any tax consequences. So your tax base should equal the carrying amount. Okay, so just take note of that. If you have any questions, just let me know. Transmissions boosters have been depreciated to date based on the expected useful life. Okay, so we will have to have a look. There's probably information regarding transmission boosters above, so we'll have to have a look at that. And then also have to have a look what is the SARS treatment, or the income tax treatment for transmission boosters. Note number 3, Econat has been conducting research into more advanced methods of manufacturing some of its transmitters. The new transmitter will be able to detect individual user needs and regulate strength and speed of transmission to that user. In 2017, so remember we are at 31 December 2019. In 2017, they commenced with the construction of a plant located in Masasa. The plant became available for use on 1 January 2018. What's important, when an item of PPE is available for use or ready for use, you must start depreciating from that date. At this date, the expected future costs of restoring the environment to its natural state due to construction, as required by law, would be 10 million Zimbabwe dollars. The cost is expected to be incurred at the end of the plant's life of 5 years. The waste product caused in the process of manufacturing the transmitters in the plant must also be recycled at the end of the 5 years, as its plastic in nature cannot decompose. At the date the plant became available for use, this cost was reasonably estimated by an environmentalist specialist who has many years of experience to be 5 million Zimbabwe dollars. So these are 15 million Zimbabwe dollars. I just want to read it. I just want to reread it again just now. So I wasn't now sure whether I picked up whether that 10 million and the 5 million is the amount at 1 January 2018, or whether it is the amount in future, whether the 10 million is in 10 years time and the 5 million in 5 years time. I mean, whether the 10 million is in 5 years time or the 5 million in 5 years time. I just need to read that again. But what you must be able to pick up, whether that cost is a cost today, or whether that cost, whether the amount is the amount that you will, it is the present value today of what you will spend in future, or whether that 10 and 5 million rand is the amount that you will spend in future. If the amount is the amount that you will spend in future, then you have to present value it to today. Okay, then you have to do a present value calculation. But if that is the present value today, we take the amount as is. So I'll just quickly reread it just now, but we'll continue for now. Mr. Musa reflected a provision amounting to 15 million rand with respect to the above in the financial statements on 31 December 2018. Okay, on 31 December 2019, the directors have revised the initial estimates of the above. The 10 million is now revised to 13 million, while the 5 million is now revised to 7 million. Okay, so what we're going to have to do is let's assume, I'll reread it just now, but let's assume that 15 million is the present value today. Okay, on 1 January 2018, that is the present value. If it's not the present value, we have to work out the present value. But let's just assume it is the present value, okay, just for this explanation. So what you will have to do, you must add the 15 million rand to the transmitter, to the PPE. So the journal entry will look as follows: debit PPE, credit provision for restoration. Okay, so a debit PPE, so you're increasing the PPE by that 15 million, and you're going to credit a provision called provision for restoration. Then each year there will be interest on that provision, so you'll recognize debit interest expense, credit provision. Okay, so every year. So therefore, at 31 December 2018, we can't have 15 million rand for a provision. We need to have more than 15 million rand because we must recognize interest expense on that 15 million rand. So that amount is incorrect. Okay, so just take note. Then they say on 31 December 2019, the directors have revised their initial estimates of the above. So the 10 million have now increased to 13, and the 13 have now, and the 5 have now increased to 7. So what we'll have to do, we must work out the present value at 31 December 2019 based on the old information as well as the new information. So we should have the new information, I mean the old information, but this one is incorrect. So when we correct it, we will have the new information. We'll have the updated information for the old. So what we will do, we'll find the present value as at 31 December 2019 of the original estimates, and we will calculate the present value at 31 December 2019 for the new estimates. The difference between the two, whatever the difference is between the two, the present value of the old and the present value of the original and the present value of the updated as at 31 December, which 2019, whatever the difference is between those two present values, you must adjust the provision and you must adjust PPE. Okay, so just take note of that. So we will deal with that just now. Okay, so they say goodwill relates to the acquisition of liquid. The tax authorities do not grant any capital allowances on goodwill. So remember, with goodwill, there won't be any deferred tax calculation. Accounting standard says there's no deferred tax on goodwill. They say due to the hyperinflation, we have already prepaid for our water electricity bills for 2020. A total amount of 6 million has been prepaid. I have already claimed a deduction for the 6 million in the 2019 returns. Okay, so if they already claimed, we will have a prepaid expense asset, but we will not have, there won't be any tax base for it. Okay, so just take note of that. Deferred tax asset base is on 24%. The tax rate announcement in the 2020 budget announced in November 2019. Since deferred tax is a future tax, we need to use a tax rate that will be applicable at the time the tax becomes due and payable. Deferred tax is based on 24%. The tax rate announced in the 2020 national budget announced in November. Okay, so that is not correct. Okay, but that's only applicable. I'm assuming this means only applicable in 2020. So you can't use 24%. You'll obviously have to use the current rate, which is 25%. The nominal market-related pre-tax rate is 12%. Okay, assume that time element is material for all periods in excess of 3 months. All investment properties are measured in IAS 40 PPE using the cost model. Okay, or the straight line method. Okay, so let's deal with this calculation. Do you have any question before we do the calculation?
Yes, Faiz.
Yes.
On the additional information, if you can go back to the additional information, I want to understand that part where they mentioned the time value of money. what is the effect of that statement really?
I'm going to explain to you when we come there. So that's going to have an impact on point number point number three. So remember I told you, if that this provision for estimate over here, this provision for restoration, if it is the amount that will be incurred in 5 years' time, we need to have a present value today. So we have to present value the 10 million and the 5 million. Okay. So, but the way it looks at it, that is the present value. So there's no need to do any present value calculation. But we still have to incur interest. So we're going to work out the interest using that time value of money calculation. Same thing with this over here. We're going to have to work out a present value for this updated information. So whenever you have to use do time value of money, present value calculations in accounting, you will use that pre-tax rate that they give you over there. What do they call it now? Pre-tax interest rate. Okay, so you will use that to do any present value calculations from an accounting perspective. Okay, does it answer your question?
Yes, Fires.
Okay. So let's let us continue. Okay. I'm quickly gonna go to Google. Did you guys manage to, for those who try to access it on Google Drive, do you get access to it? I don't know if you tried already. Remember, just let me know if you did. So, yeah.
Was the link shared, Fires, on the platform?
No. So you should have gotten an email from Edion's tutors@gmail.com.
Oh, okay.
Let me just check. You should have. So yesterday you should have gotten an email. But let me just see if I can. If here's a link I can share quickly with you. I don't see the link I can share. Maybe this is the link that you can use. You can just let me know. Okay. So now open up Excel over there, okay? Just give me a moment. So remember, what they've asked us to do in Part B is required, says, critically review the deferred tax calculation prepared by Mr. Musa and advise him on any corrections that may be required to be done. Okay, so the best way to do it is, as we go through each calculation, we will explain the issues. Okay, are you happy with that? So each time we explain, so what the best way to do it, every time we go through each line item, we do an explanation. Okay. So let's quickly have a look. I'll be quickly busy opening up a new Google Sheets. I'm going to share Google Sheet with you now. Where is this now? Okay. Can someone just tell me what's the name of this question? Is this a particular question? Is it just a mock exam? What's the name of it? Anyone?
Oh, it's just a mock exam.
So I just want to name it properly.
Okay. The name is
okay, so 2021 mock exam. So FAC FAC 2021 mock exam. That's sufficient. Okay. So FAC 2021 mock exam. Okay, so we're doing required B. Okay. So it should be in there. So if you try to access, it should be there. You won't be able to do anything on it because I only give you you can only have within Google, you'll only be able to view it and you'll only be able to comment on it, right? You won't be able to change anything in here. In order for you to make any changes, you're gonna have to download the file. The reason why I don't want to give because I don't want the thing to change, just in case someone play around, you make a mistake, and then Google automatically saves in the thing. We don't know where things changed, so that is why we just keep it as is. I have edit rights, but once you download the file, you will be able to see all the formulas and make any changes. Then it's your file. Okay, so that is why I chose that approach. So let's go back to the scenario. So what I'm going to do, I'm just quickly going to just so for ease of calculation and so forth, I just quickly want to put in everything. Okay, so we're gonna have assets, liabilities, assets, liabilities. We will have carrying amount. We will have tax base. Okay. So carrying amount, tax base. Then we'll have temporary difference and deferred tax. I'll just put in here temporary difference. Okay. Someone can just help me with reading off the information. So I know it's investment in all mutual shares. Okay, so in investment in old mutual shares. The next one was transmitter.
Transmission booster.
Transmission booster. Then
Transmitter plant.
Transmitter plant. Then
Provisions. Is it correct?
Just provision.
Mm.
No, then it's goodwill.
On the table, there is goodwill.
Then it's goodwill.
Trade and
Trade and
other receivables.
Other receivables. Then it was
Cash and cash equivalents.
cash. Okay, next.
Trade and other payables.
Trade and other payables.
Taxation payable.
Payable, and then taxation payable. Taxation payable. Okay, then we have over here, now put in the amounts. So I remember this was 25. This is
126.
25. Okay, and then
126.80.
126,080, like that.
No, 126,000.
Oh, 26,000, and then 80,000.
80,000.
80,000. Okay. Yeah.
Then 50,000.
50.
Then the next 25,000.
25,000. Okay. Goodwill was 300. This was 0. Okay, and then 300 receivables.
030.
What? 0.
14,030.
030. This was
8030.
8 or 6.
Yeah, 8.
Like that.
Yes, correct.
Okay.
16,045.
16,045. 16,045. Okay.
1437 down there. Negative 1437.
14,
37. 1437.
14, just like that, 1437.
37, yes, correct. The
Okay.
next also 1437 minus
7. Okay, so 0, and that one was 200.
100, yes.
Okay. Thank you. Total, okay. There we go. So here we can see that minus that. Okay. Okay, so there we go. Carrying on minus tax base. So there we go. Okay, so if we have a look, we can, if you have a look at his answer, you can already see that something is wrong. Okay, so the first issue you can pick up that he added up incorrectly because we have exactly the same numbers. So he added up incorrectly. He added up incorrectly. As a result, his temporary difference is incorrect. And so as a result, his deferred tax is incorrect. Okay, so without evens, looking at the detail, we can already tell him that his mathematics is by adding up, they call it arithmetically. This numbers is arithmetically incorrect, meaning it's added up incorrectly. So here, I don't think Google can lie, right? Google doesn't make mistakes. So so you can see that these numbers are completely different to ours. And as a result, that's the first point you want to make mention, that without even looking at the detail of his calculations, the first problem, he added up incorrectly. So even if this is 100% correct, his numbers over here, because the arithmetics is incorrect, the adding up is incorrect, his temporary difference is incorrect, and as a result, his tax is incorrect. Are you happy with that? His deferred tax is incorrect. Are you happy with that? Do we follow?
Yes,
Yes.
we are
Okay.
following.
So that's a 1 point, but that is without looking at the details. Okay, so you must be very careful. This is a common thing when they ask you to critically review, to have a look at the arithmetics. Okay, adding up the numbers. They like to do this in a valuation question as well, where they give you the valuation, the finance manager or someone performed the valuation, and then they ask you to critically review. The first thing you do the basic stuff, checking numbers and stuff like that. If there was a increase of, like yesterday we covered, there's an increase, there's a rate increase and so forth. You want to see whether they applied the rate increase in correctly and so forth. So without looking at the technical details, you look at those stuff first, and then you go into technical details. Okay, so there'll be like 3 to 5 marks on those stuff. You don't want to go and write a thesis on arithmetics, but you want to bring up the common points. The only time you don't do that is if the required, when you read the required, and sometimes in the required, they'll tell you what you need to do. So that if they say ignore arithmetics and all of those type of things, then obviously you ignore it. But if they don't tell you to ignore it, then it means they expect you to do an arithmetic calculation, to do the add up, reperform a calculation to see that they did it correctly. Because sometimes the numbers used are correct, but how they applied the mathematics is incorrect. Okay, so just remember about that. Then the next level would be is to have a look that each of these numbers that they're putting over here is now correct, and now you must apply the various accounting standards. Okay, so just be aware of that. Okay, so I'll just put in your comments. You can set it up maybe like however they would usually set it up. But because I have this over here, I'm just going to put in comments over here, and then we will have a discussion on it. Okay. So let's have a look. So let's have a look. So with our mutual shares, like I said, for me, the mutual shares should be, is the way it is done is correct. Okay. So, I want to ask you quickly, how does your Income Tax Act deal with shares? Do you know?
Yes.
Okay, so tell me.
We've got a different act that deals with shares, which is called capital gains tax. Yeah.
How do they deal
So
with it?
we don't use the income tax. We use the capital gains act, which has got a different rate for shares.
Okay, so then how does it work for how does it work?
Because this is Old Mutual is a listed company.
Yes.
It means the CGT rate there is 1%.
Oh, so you would take 1% of the fair value of 25,000.
Yes.
So then the tax base is so the tax, so what would be the tax base? Is the tax base just 0?
Yes, the tax base will be 0.
Okay, and okay. So you see that's different to so yeah, in South Africa, if I remember correctly, what we would do, we use the Income Tax Act. The Income Tax capital gains is part of the Income Tax Act. Okay, so it's not a separate act. Okay, so capital gains is part of. So like in South Africa, they see various taxes. You have income tax, you have value added tax, you have customs duties, and so forth. You have donations tax. So you have different types of tax. Capital gains tax is not a separate tax. Capital gains tax form part of income tax. Okay, so included in the Income Tax Act would be capital gains tax. So what would happen is the tax base would be the cost price. Okay, so if you bought shares for 20,000, the tax base would be $20,000, right? And only once you sell the shares, so therefore there will always be a deferred tax implication from an accounting perspective. When we do our tax, because maybe like let's say the accounting treatment is to use fair value. So now fair value is 25,000. But then in the tax act says, no, your tax base is your cost price, which is 20,000. So then we would have a temporary difference of 5,000, and we multiply it by, if it is a capital asset, we multiply it by the capital gains tax rate. If it is if you're using for trading purposes, you use the normal tax rate. So that is how we would apply it. So let me just quickly understand from your side. So from your side, the carrying amount is correct as 25,000. Okay, so you are saying the tax base, if you apply Zimbabwe's tax rules, this will fall into, shares will fall in the Capital Gains Tax Act. And in terms of the Capital Gains Tax Act, the tax base would be 0. Yes, no, or what would be the tax base?
I think why it could be 0 because we are using the fair values.
So if you do this calculation, would you put in here 99%? So if I just say 25,000 times 99% is, no, it wouldn't be like that, because you're saying the deferred tax is 250 and not the temporary difference. Is that what you're saying?
And the deferred tax will be 1%. That's what the answer is. So in terms of
Okay.
our capital gains, the tax base, we are saying these are, what can I say? The allowable deductions. So we don't have any allowable deductions here.
Okay, so you saying this
That will be 0 now.
is 0.
Yeah.
Okay.
So now you go and say 1% of the 25% of 25,000.
Okay, I understand. So you are saying if I do this over here, insert temporary difference. So if I say deferred tax, it will depend on the rate. So if it's a capital asset and it's shares, we're going to say temporary difference times 1%, like that.
Yes.
Okay. Okay. Okay, so that so you see, like, so for this aspects, I obviously can't help as much because I don't know Zimbabwe tax law, but I can give you the thinking process. Okay, so we're happy that maybe quickly see someone had a question here, their hand raised. Let's just see quickly. I think Walter, did you have your hand raised? No? Anyone? No, okay. Yes, yeah.
I just wanted to say that with regards to shares, they have a tax base of 0. So if we say 25 minus 0, we get the 25,000. Then when we are calculating the deferred tax, we can't use the income tax 25 or now it's now 20%.
Yeah.
We have to use the capital gains one, which is
Yes.
1%.
Yes.
So it also varies. When it's something like some immovable property, we use 20% because also it doesn't qualify under the income tax.
Okay.
That's all.
Okay, so we're happy with that. Okay, so you can obviously help me with the tax implications. I can give you the thinking process. So we're happy that, so you have to discuss to them then. So obviously the first point we'll make mention, it doesn't matter where you want to mention the arithmetic, somewhere the arithmetic needs to come in. Okay, you can already see he did a mistake initially. Okay, I'm just changing as we go along. I actually should have, let me just quickly, I'm just going to change this back quickly. Just give me a moment. I'm going to change this back. Okay, so I'm going to change this back. So here we can see he made an error. Okay, so I'm just changing this back. So this is his original calculation. So somewhere you're going to have to tell them that his arithmetics was incorrect, and as a result, his temporary difference is incorrect, and ultimately his deferred tax is incorrect. Okay, so you just need to make mention of that. Now we're going into the specific calculation. So this here is 0. So you have to tell them that he correctly used $25,000, the fair value amount, as a carrying amount for accounting purposes. However, the tax base can't be 25,000 as there's no allowable deductions, and as a result, because there's 0 allowable deductions, our tax base is 0. And since it is a capital asset, your deferred tax is 1% of the temporary difference, which is 1% of 25,000, and that results in $250. Okay, so somehow you will word it like that. Are we happy with that? Any questions? Can we move on? Okay, so I'm going to move on. Now let's deal with the transmission boosters. Okay. We will have to first go work out, or no, not work out, find out what is the tax rule, what is the tax allowances for transmission boosters, and what is the allowances for, or the depreciation or the useful life for the carrying amount. Okay, so somewhere in the scenario, they must have given it to us. So let's go answer and go look. Okay, let's just see now. Okay, so if you go to page 3 on your scenario, can you quickly go there? And then there'll be the second paragraph. I'm gonna read through that quickly. Just tell me once you're there. You guys
Yes, we are there now.
Okay. So they say Econet seized the opportunity and was quick to construct a booster in the Kamativi area in Binga. The subscriber count in Binga is not expected to be big enough to reap a positive investment return. On 4 April 2019, Econet purchased 1 acre of land in Kamativi for $26,000 and started construction of the booster. The construction of the booster was complete on 30th June 2019 for $100,000, and it became available and ready for use on the same date. So it became available for use on 30th June 2019. Okay, we are in the 2019 financial year, 31 December 2019. The booster has a useful life of 20 years and an estimated residual value of $10,000. The booster has a capacity to house 20 transmitters. As at 31 December 2019, the booster has a fair value of $115,000. Okay, remember, this is a PPE. Well, it have to depends. What is this actually? Is it a PPE or is it investment property? So on June 2019, Econet entered into contracts with 17 cellular telecommunication entities, which allows the entities to connect the transmitters on the booster. The contracts are for a period of 20 years. Each entity pays $5,000 per annum to Econet for the duration of the contract to be able to transmit using the Econet booster. Econet has also set up its transmitter on the booster to make the total transmitters 18. Mr. Musa is not quite sure on how to correctly account for the costs relating to the booster and has raised the following entries in the Econet 31 December financial records. Okay, so debit land, debit suspense account, credit bank. Okay, so debit land, probably correct, but we may want to take it to a specific place, and then debit suspense account. Obviously, we can't debit a suspense account, we have to debit something, and credit bank. Okay, so what you must understand, the question would be, is this PPE or is this investment property? Okay, so this is actually mentioned specifically in, I think it's mentioned specifically in the accounting standards. So this was when this was like a real discussion point for the handbooks. The accounting handbooks is set up by the International Accounting Standards Board, right? So the IASB, International Accounting Standards Board, and this issue of telecommunications was a real discussion point. And what is concluded actually, that investment property is not just how we think about in terms of a land and buildings. Okay, so investment property is basically any fixed structure that is used for capital appreciation and or to earn rental income. Okay, so investment property deals with a fixed structure that is used to earn rental income and or used to earn capital appreciation. So the question would be, so the big question came in with, so this is a tower basically. So a booster is like a telecommunication tower. So I don't know, what are the telecommunication companies in Zimbabwe? But in South Africa, we have Vodacom, Cell C, MTN, and Telkom. Now, obviously, Vodacom and MTN are the big ones. So they have these huge towers that they will place on different areas, right? In different areas in order to cover connectivity. Okay, so people can have connectivity. So the question would be, how do they treat these towers? So I'm assuming they call it a booster. Okay, how do you treat these booster towers? Do you treat it as PPE or do you treat it as investment property? Now the question is, what is investment property? Okay, so investment property, is it only land and buildings, or what exactly is it? The accounting standard doesn't say land and buildings. The accounting standard says a fixed structure. So the question was, what is a fixed structure? And accountants obviously don't know what a fixed structure is. But if you ask, if you speak to, let's say, civil engineers, or you speak to architects and you ask them what is a fixed structure, they have a different answer, right? So is a fixed structure something that has a roof? Is a fixed structure just something that is fixed in the ground and can't be moved? What is a fixed structure? So it's not really clear what is a fixed structure, okay? And so this was a big question that needed to be asked. So the accounting standards made it clear that for towers, telecommunication towers, it will meet the definition of a fixed structure, and as a result, it will meet investment property. So that is what you need to understand. Okay, so a booster, a tower, is an investment property because it's a fixed structure, and in terms of the accounting standards, it meets the definition of a fixed structure in terms of IAS 40. So that's important to take note. Okay, so we will see now how you guys classified it as. I'll look at the solution quickly to see. But in terms of IAS 40, a tower and a telecommunication tower, or whatever you guys, what is this called here, a booster, is going to be IAS 40. Now remember, if you the additional information in the scenario said IAS 40 is treated, the measurement model is fair value. So what this debit had to be, so the debit to land, because they bought it for this purposes, must also go to, it needs to be debit investment property, and then the suspense account must also be debit investment property, and then I'm assuming they did pay cash, so then correctly credit bank with 126. So here you can see it is a fixed structure, and they are using this structure to earn rental income. Okay, so as a result, because they are earning rental income, you can see this on 1 June 2019, eConnect entered into contract with 17 telecommunication entities, which allows the entity to connect their transmitter on the booster. The contract of for 20 years, each entity will pay $5,000 per annum. So you can see for 20 years, they must pay $5,000. It is the earning rental in effect. And the tower is considered, or the booster is considered, a fixed structure, and therefore this meets the definition of IAS 40 investment properties. So the boosters are investment property. Yes, Justin, you can ask.
Okay, my question is on land. Is there, so it is a given that if you have an investment property like this tower that we are talking about right now, that you have exhausted the definition and how we have come up to recognize that as an investment property, does it also follow that the land that the investment property is on is actually automatically becomes investment property?
Yes, because remember, in order for it to be PPE, in order for it to, the whole purpose of you buying the investment property, the whole purpose of you buying the land is for the booster. You're not using it in the production of income. You are not using it not owner occupied. It is used to host the fixed structure, which is used to earn rental income. So the land will also be classified as investment property. Okay, there's no other purpose for the land. So there's no real purpose for land. So for example, if you read IS 40, they will tell you some people buy land just because in future they want to do something with it, right? And while you have land and you have no proper intention, right? You don't know exactly what you're going to use it for. You need to treat it as IS 40, investment property, until you know exactly what you're going to do with it. So here, you're only using the land for the hosting the fixed structures. There's no other purpose for the land. So even if you just bought land and was holding there, you must also treat it as investment property. So because the land is not used for owner occupied, is not used, you're not owner occupying the land. You're not using it for your own business purpose. You're not using it by hosting a head office or something of that nature. It is hosting a fixed structure that is earning rental income. So as a result, it will also be classified as investment property. That is what I would do. Okay, we will see now what actually gets done. Okay. So let's just have a look. I can't see do you have standard rules for tax allowances? So I don't know what's tax allowances over here.
Tax allowances are just, what can I say? For if you've got an asset that you use, you deduct what we call capital allowances.
Yeah.
For the booster, I think it's about 25%.
Yeah, that's what I'm saying. Like, how do you know it's 25%? Because they don't tell you here. So must you just know it's 25%?
I think we've got the income tax actually provides that.
Oh, so income tax specifically provides that. Okay.
Yeah, provides.
Okay.
If it's a commercial building, if it's something, it's a motor vehicle and all that, it's all provided.
Okay, no, so like, I don't know, I was looking, what is it? So it must be what you call it. So obviously they're gonna work it out based on cost price. So for tax purposes, the tax base will be based on cost price. So let's just see what the cost price is. So Econet sees opportunity to quick. Okay. On 4th, they bought 1 acre of land for 26,000. Okay, and started construction on the booster. Construction on the booster was completed for $100,000, and it became ready for use on the same date. Okay, so 30th June. The booster has a useful life of 20 years and a residual value of 10,000. The booster has a capacity. Okay, so in 1 June, okay, that's fine. So, and your land, how do you treat land? I'm assuming there's no deduction for land. How would you guys do that?
Yes, the land does not have any capital allowances.
Okay. So I was going to see what did Musa do quickly. So Musa did 126 for, and then the boosters of 80,000. Okay, so he should have said 100,000 divided by 4 years, which will give us 100 divided by 4, which will give us 25. So shouldn't our thing have been 75,000? That's what I would have thought. Oh, no, but yes, but that's correct because it is. And must you use what I want to know, do you guys have to use Do you do partial? Or is it, if it's in the year, you get the full year, or must you use based on the time you have used?
I think capital allowances are granted full.
Full year, irrespective of when you start during a year.
Yes.
Okay, so that is obviously what we'll have to. So our expected years thing to be 70, to be 75. I would have thought, if it's 4 years. So you see, the difficult part for me is I'm not 100% certain how you would treat your capital allowances. That is the only thing from my perspective. How do you treat your capital allowances? This is how I would have done it. So let me just explain to you. If I do tax rules, if I use in terms of accounting, this is how I would do it. I mean, not accounting. If I do it in terms of South African law, right? Tax law, this is how I would do it. You might just now tell me how to get to the tax space based on how Zimbabwe would do it. So we will split the transmitter. So I'm going to do it at the bottom quickly. We will split the transmitter between now land and the transmitter. Okay, transmission booster. This is how we would do it. So even though the land is investment property, you will still split them up. Okay, so the land 26,000 for tax purposes, it also be 26,000. That's the cost. Okay, so the temporary difference would be 0. That minus that would be 0. Okay. Then, so this is as at 31 December 2019. Okay, so as at 31 December 2019, we would have a carrying amount of 115. Okay, the tax base in total would be, so you said if I'm using your rules, it'll be cost price of 100,000 divided by 4 years, gives me 25,000. We get the full 25,000 irrespective of the fact that we acquired it during the current year. So that means my tax base would be 100,000 minus 25,000. Okay, so my tax base is 75,000. Okay, but now obviously for tax purposes, there's going to be two aspects over here. There's going to be a CGT rate as well as a normal income tax rate. Okay, so because of the fact that the transmission booster exceeds the cost price, 15,000 would be at the CGT rate, and the amount, so 75 up until 100,000, the difference of 75 up till 100,000, which is 25,000, that will be accounted for using the CGT rate. I mean, you will be accounted for using the normal tax rate, and then the 15,000 will be accounted for using the CGT rate. So how would you guys treat that? That is what I want to know. Do you also split between, if an amount exceeds cost price, the tax base, would you also attract CGT? That is what I need to know, because that's going to have an impact on the deferred tax calculation.
I think we
that
also
is how.
use this.
I think that's the same treatment. I don't know if that's what I wanted to say.
Okay,
No, we only on that if there is revaluation. Well, the moment we revalue something, we now go to CGT.
Yes.
We now use the 20%.
So that means.
Okay.
So
maybe let me come in there, Tao. I think from carrying amount to revaluation, that's where we use normal tax rate, right?
Yes, correct. Then
from cost to the tax base, we use that CGT rate. I'm not sure if that's the
so
principle
the counting the way I can't say accounting. So like in South Africa, the amount above cost price, okay, the amount above cost price. So our cost price is 100,000, and the amount is the amount above cost price, which is 100,000. So anything above 100,000 would attract CGT, and anything from cost price below will attract a recoupment, which is your normal tax rate. So, for example, it would work like this: through sale.
Yes, I think that's exactly what I wanted to say again there, Faiz, that from the cost to the tax base,
yes, so
we use normal tax rate because it's recoupment.
Yes, so then it'll be 115 to 100.
Yes,
It would be 1 minus 100. That accounts, that accounts for 15%, 15,000, and then through use, if I just do that, where's this? It would be I think 115. Yeah, then it's going to be 100 minus 75, which will give us our minus 75, which will give us our 25. So as you can see, if I just add this up over here, what you ultimately want is that this total needs to add up to your carrying amount versus tax base. Carrying amount 115,000, tax base 75, which gives us 40. But we know here is this 40,000 is made up of two aspects: your normal tax rate and then your CGT rate. So we need to split what is the CGT rate, which is generally through sale, will generate capital gains, and then through use will generate through use will generate what am I looking for here? Your normal tax rate or your recoupment. So this is how we do it here in South Africa, applying accounting rules and using the SARS rules. So I'll just need to know from your guys' perspective whether that is correct. So if I must apply accounting, if I must use how we do it in South Africa, using your information, this is through use. So we'll apply the normal tax rate at 25 or 24%. They just use 24% for now. We'll come to that rate just now. And then over here through sale, your CGT rate, you would say is 20%, if I understand correctly.
Yes.
Correct.
So then we would get that. So I don't know if this is correct.
It is.
I'm sure it is correct. That is one principle that I was failing to grasp. And thank you for making it clear there, because I was just struggling with this from cost to tax base, from carrying amount to revaluation. Yeah, I think that's it.
So that is what I would think it would be. I don't know what is the actual answer in your I don't know what's the actual answer. We'll have to have a look, obviously, but you guys can check the actual answer. That is kind of what I would do given my understanding of how the tax base is. Okay.
Yeah, I don't mind that 126. I think it should be incorrect, that one. I'm not sure where exactly. When I went through that one, I think there is one figure which is incorrect on that solution.
Okay.
I don't remember which one exactly.
Okay, so what you'll just then, this is how you'll do it, but then you obviously remember you have to discuss it now, right? So when they say critically review, so then you will tell them that the transmission over here, we need to split it into two aspects. So you must split it between the land and the transmission. Both land and the transmission is in terms of IAS 40, but you have to split between transmission and land. Okay, the land have not changed in any value, so the land remains 2626. I didn't see any changes, so therefore there will be no deferred tax implications because tax base is equal to carrying amount. There was no fair value adjustment for the land. If there was a fair value adjustment to the land, remember, I doubt, like here in South Africa, the income tax wouldn't take in a fair value adjustment. I'm assuming your tax rules also wouldn't take in a fair value adjustment. Okay, so your tax base would remain the cost price. This will be your fair value. Now, it didn't, they never mentioned that there was a fair value adjustment to the land. So therefore, it's safe to assume the land remained the same. So therefore, there will be no tax consequences, deferred tax consequences on the land. If there was, you would apply the same rule as we did for through sale, okay? Then the transmission, the carrying amount needs to be the fair value as at 31 December 2019, which is 115,000. Your tax base is the 75,000, but you can't simply say 115 minus 75 because there are two aspects to this thing. The way you're recovering, the way you're recovering, the way you're benefiting from the asset is both through use and through sale. So the sale part is the amount that exceeds your cost price. So that's what we're doing over there. And then the through use is just basically cost price minus your tax base, which will give us 25. Ultimately, you want this 40,000. You want the total temporary difference to be carrying amount 115 versus tax base of 75. Okay, so just remember that. And CGT will only you'll only draw CGT tax for the amount above tax, the above cost price. Cost price 100, so CGT should only be 115 minus 100, and then everything else is a recoupment, and that's why that draws the normal tax rate. Okay, so we usually have to have a look at your numbers. I'm not going to look at the solution still, but that is how I would think through it, how you would break it up. What you must know that both the land and the transmission is investment property. But when you want to do these type of calculations, even in your disclosure, you're going to have to separate land from everything else. Okay, so remember, both the land and the transmission meets investment property, but does not mean you combine them. In the investment property note, you will have land as a separate column. You'll have transmission booster as a separate column. Okay, so just keep that in mind. So that is why we split it over here. So you can tell him that the transmission booster should be split between land and transmission booster. Land being 26,000, the transmission booster is incorrectly accounted for at 100,000. It should be 115. How we got 80,000, I have no clue. So are you sure it's a 4-year, not a 5-year? Okay, but you guys can check that out. Okay, so just keep that in mind. Okay, so let's just have a look how we're going to deal with
that,
yeah.
The 80,000, I think it's it was on the scenario, which means it was calculated incorrectly. We're addressing that those calculations on this scenario. So I might think maybe it was a discussion point.
Okay, so we just have to have a look at that. Okay.
And also the text base confirm is wrong. Eh? It's supposed to be 75.
Yeah, so you guys just need to check that out. Okay.
Yeah, because long, in our, we know when you calculate that CIA that they call it special initial allowance, it's 25% of cost, which is 25.
Yes, and there's no and there's no and there is no, what you call it, right? There is So you always take a full year, even though it is only part of the year.
Yes.
Okay. Okay, no, that's fine. So you're happy with our numbers for now? Anybody else? Tinashe, Walter, we happy? I think Kudza is also, yeah. Let me just see. Eddie, Walter, you fine?
Yeah,
Yes.
I just want to ask something with regards to the tax bases.
Yes.
Did we adjust for the capital allowances? I can see 100,000 and 75. Can you assist on that part?
Where is 300,000?
Do you see through cell, we've got the tax base is 100,000.
Yes, yes.
How did we get the 100,000?
Oh, you just make it cost price.
We use the cost price.
Yeah.
We didn't adjust for capital allowances for that year.
No, because for through sale, the ways, so yeah, in South Africa, and I'm assuming in Zimbabwe as well, when they work out a through sale, let's really try to think quickly. Yeah, so the way you will do it is what draws the CGT rate. It would be the cost price of your asset. Okay, so what draws CGT? Anything above cost price draws a CGT rate. Anything below cost price will draw will draw a recoupment, which is your normal tax rate. So the general rule would be anything above cost is CGT rate. So the way to get above cost is to just make sure that your tax base is cost price and you compare that to the carrying amount. Okay, so that is generally how it will work. Does that make sense?
It's fine.
Yeah.
And the 75,000.
The 75,000, that is based on, if I use 100,000 divided by 4, I get the annual allowance of 25. I say 100 minus the annual allowance. It was only 1 year. So remember, we acquired in 30th June 2019. Our financial year is 31 December 2019. So we're in the 2019 financial year, only count for 6 months. But like you said, similar here in South Africa, in most cases, an allowance is not apportioned for part of a year. You get the full allowance. So we're taking the full allowance. So 100 minus 25,000 annual allowance give me a tax base of 75. So now I'm saying, okay, my current thing is 75. I compare it to cost. Because remember, I can't compare to 115. I already accounted for the 15,000. Now I say cost minus 75, give me a tax base of 25,000. So that temporary difference of 25,000 will draw normal CGT, and the other part will draw, will draw normal tax, and the other 15,000 draws a CGT rate. Yeah, I'll think of another way of presenting it, but just give me some time to think, then maybe it'll be a bit even more clear. But for now, that should work. Okay. I'll be okay with that.
Thanks, it's okay.
Okay. Eddie, any questions from your side?
No, advice, thank you.
Okay. Now, let's go through. So goodwill, there's no deferred tax on goodwill. Okay, so just remember, just tell them no deferred tax on goodwill. So therefore, you don't include goodwill in your deferred tax calculation, so it needs to be removed. Okay, cash and cash equivalents, that is correct. Trade and payables, that's fine. Taxation payable, no deferred tax on taxation payable. So taxation payable must be removed. Cash and cash equivalents, that is fine. Goodwill must be removed. Okay, trade and other payables, that is fine. Now we need to deal with trade receivables and the transmitter plant. So I'm going to go back to the scenario for the transmitter plant. I just need to see, can't remember what was said. So transmitter plant, 50,000, 25,000, note number 3. Okay, so they're saying Econac conducting research. Okay, the new transmitter will be in the 1 January. Okay, so it's got to do with a provision. So they definitely accounted for the provision incorrectly. Okay, so they definitely accounted for the provision incorrectly. So at 31 December 2019, what is the provision? That's the big question. So what is the provision at 31 December 2019? We will have to have a look. What is the provision? So remember, SARS don't care about the tax base. So the tax base is going to be 0, but we need to work out what is the provision at 31 December 2019. So I'm going to show you how to do it. And then from there, we will have a look what needs to be done. Okay, so let's just have a look. So the provision would be as follows. So this is how you'll do. I'm going to do the provision separately so you can see. So on 1 January 2018, okay, if I read it correctly, it's that 10 million and the 5 million is the present value. Okay, so it is the present value. Let me just quickly, it is the present value. Let me just go read it again. So just go to note number 3. So they said, at this date, the future expected costs of restoring the environment to its natural state due to construction as required by law would be 10 million. This cost is expected to be incurred at the end of the plant's life of 5 years. Okay, at this date, in January 2017, they commenced with the construction of a plant located in Masasa. The plant became available for use on 1 January. At this date, the expected future cost of restoring is 10 million. Okay, the cost is expected to be incurred. Okay, the waste product caused in the process of manufacturing the transmitter plant must also be recycled at the end of 5 years. Okay, at the date the plant became available for use, the cost was reasonably estimated by who has many years to be 5 million. Okay, Mr. Mafuza reflected a provision of 15 million with respect to the, okay. I'm not 100% certain now whether it's not 100% clear, but basically we're going to have, what was that now? Transmitter, so PPE, transmitter, and then provision for restoration, we have SFP and we have SFP, okay, debit, credit. So it doesn't seem that that was actually the present value. So we need to work out the present value. In order to work out the present value, you need the future value, you need the payment, you need N, and you need I. So we want the present value. Okay, so the way I read it, I may be wrong, okay? But the way I read it is that the 10 million and the 5 million is the cost we're going to incur in future. It is not the present value. So we need to work out the present value on 1 January 2018. So we want the present value. So the future cost is going to be 15 million. Okay. I'm using in rand thousands, but all the numbers are in rand. So it's 15 million. So let me just do it like this. So it is 15 million. But because the numbers are in rand thousand, I'm dividing by 1,000. So we have 15,000. The payment is your fixed regular annual payment, 0. N is 5, and then I is at the discount rate they gave us in the additional information. I can't remember how much it was. 12%. In accounting, you always use the pre-discount, pre-tax rate. If they give you a post-tax rate, you must convert it into a pre-tax rate. So the reason why accounting won a pre-tax rate, accounting accounts for tax separately. Remember, we have a line item in the income statement called income tax. So therefore, any other number needs to be before tax. So if this rate given to us was after tax, we needed to convert it into a pre or before tax rate. So because it is a before tax rate, we use it as is. So the present value would be, okay, what do they want first? Okay, so they want number of periods, payment, future value, beginning or end. Okay, so they want I, then they want, okay, number of periods, then they want payment, then they want that, and it's happening at the end. Okay, so so it looks like the present value is this amount over here. Okay, so like I said, if the 15 million is the present value, you'd have said debit 15 million, credit 15 million. But the way I'm looking at it, it doesn't seem that that is the present value. It looks like the 15 million is what you will pay in 5 years' time. So we don't want the amount that you're going to pay in 5 years' time. We want the present value today. So to convert the 15 million in 5 years' time to a value today, we work out the present value. So that gives us the 8.5. Okay, so so that gives us the 8.5. Okay. Then at the end of January, at the end of January 20, at the end of January, so then at 31, so at 31 December 2018, all you're going to do is for the provision, only specifically relating to the provision, you will say interest expense, and you will have provision for restoration. So all we will do, this is P&L. So all we will do, we will say present value multiplied by the interest rate of 12%, and that is the answer over there. Okay, so it will equal. But now it is slightly different. Okay, we don't have to go through this whole process. I'm just wanting to show you how you do it on a normal basis. We're working out deferred tax, so we don't have to go through all the journal entries. All we have to do is work out the present value at 30th June, at 31 December 2019. So to answer this particular question, the provision would be as follows. Using the same format over here, using the same format, we want the provision. So here I'm going to say provision as at 31 December 2019. Okay. So now the fair value is no longer 10 and 5 million. It is 13 and 7, which is now 20 million. Okay, so it is 13 million, 1, 2, 3, 1, 2, 3, plus 7 million, 1, 2, 3, 1, 2, 3. And I'm divided by 1,000 because we're working in rand thousands. So now it is 20 million. Payment is still 0. This thing started 1 January 2018, and we're going to pay it in 5 years' time. We are now 31 December 2019. 2 years have passed. So therefore, N represents the remaining periods. So N is 3. The tax rate is still 12%. So the total thing should be, the total provision at 31 December should be, I would have gotten 14 14 million. So in my mind, the provision should be 14 million. Well, you can do two separate calculations to get the actual split. So the tax base would be 0 and the provision should be our 14 million. That is how I would have done it. Whether that is how it's actually done is a separate issue now. Just want to see quickly, how did they, what does he have? If I read the number 3, Musa reflected a provision to Zimbabwe $15 with respect to the above. On 31, the directors have revised the initial estimates. The 10 million is now 13. Okay. I just changed this information quickly. It's not 100% clear how they're treating the provision. If I use, this is the new one, original difference.
The original number of years, is it 3 years?
No, the original, no, so remember, what we're doing over here is assuming, like that's not 100% clear to me from the scenario, okay? So with the original, we're still working out the provision as at 30th June 2019, 31 December 2019. So the present value for the updated information of the provision at 31 December 2019 is 14 million. The original provision at 31 December 2019 is 10 million. So the adjustment that needs to be made is 3.5 million. But it's, yeah, so that the adjustment to the provision needs to be 3.5 million. That is what I'm saying. Tax base will still be 0, but SARS doesn't see a provision for restoration. Remember, SARS will only take into account a provision once it's actually incurred. So that's what we do in South Africa. I'm assuming it'll be the same in Zimbabwe, that you only get a deduction for liability and an expense when it's actually incurred, as opposed to estimating when it will occur. So if he accounted for the original one correctly, we only need to take into account the adjustment for the new information, because you have not taken into account the adjustment for the new information. So for me, what is not 100% clear? What is clear, he did not take into account the new information. What is not clear, whether the original information have been taken into account correctly. If the original information have been taken into account correctly, all you need to do is account for the adjustment between the new or the updated and the original. You must use the 3 years. You're using the original information, but you're using the original information as at 31 December 2019. As at 31 December 2019, the remaining years is 3 years. Okay, because this thing started 1 January 2018. So what have passed? 31 December 2018 have passed. 31 December 2019 have passed. 2 years have passed. So how many years is remaining? 3 years. So we're using the original information, but you must update the remaining number of years. So the adjustment to the provision as well as to the PPE must be 3.5. Now, like I'm saying, it's not crystal clear whether the PPE has been updated or not. If it has been updated, all you have to do is take into account the additional 3.5 for the provision. But if the provision have not been taken into account at all, then we need to account for the 14 million. But you can look through the solution, what is the correct approach, as in whether they have already accounted for part of it. If you have correctly accounted for the original, you only take into account the difference. If the original is not there even, then you must take into account the total new balance. Like I said, the scenarios are really good, real world scenarios, but some information is really not 100% clear as to what have actually been taken into account. Like I'm still familiarizing myself when I read the scenario, what do they actually mean? You understand? Maybe with you have been there for quite some time now, you know what they mean when they word certain stuff.
All right. So I have also tried to attempt the mock, especially this part, the provision for restoration, provision for recycling. I still couldn't figure out also how they got to those figures. Maybe if somebody else also can actually come in on that anchor that you're saying, which one was correctly accounted for? They previously accounted provision correctly? Which adjustment are we making? Is it the difference? Yeah, boss, I just thought maybe I'm missing out the whole thing now.
Yeah, so for me, this is what I would.
I think if you look at our calculation, remember the ones we're looking at, remember the provisions were never put. They were never put in this calculation. They were never part of the deferred tax calculation that was done. So it means they were left out. But what I've seen, they've separated. When is the recycling and the restoration? Are they happening the same time?
So technically you will separate them, but because they're happening the same time, it's totally fine. In the real world, when you disclose them, you will have to separate them. The reason being is each one is a separate payment. You understand? You're not paying to the same party. You're paying to two different parties. So in terms of accounting, when you pay to two different people, somewhere in your financial statements, you need to separate them. It doesn't have to be in the tax calculation. You understand? It's just a calculation, so you can combine them.
So even if you separate them, the
You
figures are
separate
still
them.
high.
Okay, so
Yes.
Okay, so if I separate them, so if I just separate them.
So that means that the future values.
What was the first one again? The first one was, let me just check. One is recycling, and the other one is just a normal restoration. Okay, so let's just see. So if I just say restoration, and if I split here, recycle. I say recycle. You see, like these are like, as you work through, these are types of the questions you will ask your lecturers, like why this, why that. Like I wouldn't be able to answer them because they know what they were thinking when they were sitting the exam, right? So you will have to ask them, why do we do it like this? Why did we? So let's say they only take into account the difference. Then you must ask them, so why only the difference? How do we know that the original has been taken into account? You know, things like that. That is what you will ask. So if you do a question early, you will find out these differences and then you go ask them and you get some clarity. Even like with the UNISA question, sometimes when we work through a question and then I get a different answer, then we'll just go find out. We can't see, we look through the solution and stuff, we go find out, and then the student will go find from the lecturer. Obviously, it's going to take a bit long to respond, but when they respond, then you can actually find out, okay, where did we go wrong? What were they thinking? You know, things like that. And then you start to learn, okay, when they mention like this is what they are thinking and things like that. But it takes some time to actually get right. So 10 million, 13 million, Okay. And then this one would be 5 million and 7. So yeah, that is my thing over there. So the full amount is a temporary difference, and as a result, you'll just multiply by the 24%, whatever rate you must use. So I think that is all. The only thing we need to cover is train other receivables. So
I think I
yeah,
think I've been especially on the 10,000 is which one?
the restoration, the environmental restoration, the recycling is the 5 million.
What I've just done, I'm not so sure whether I'm wrong or I'm correct.
Okay.
I've just gone and I say the 717. Remember, it's the present value.
Mm-hmm.
Confirm.
Sorry, Tao, can I interject?
Sure.
Okay, the 1423 recycling, can you go to the solution? I want to see if that's the figure that is on the solution files. 1423. I think I saw something like 1423. Oh, okay. I think that one should be correct, right?
Let me just see.
I think if you just multiply it by 1,000, I think it should be in that millions. 1423561. The recycling, I think if you apply the solution on that Excel should come up to 1423561 difference. Yeah, so I think I saw where I was missing this. So it is the difference that you are taking into account, right? Was that the answer on the solution? Yeah,
so like for me, what is not clear is why is that the answer? You understand? So for me, that is my answer would be why is that the answer? Because yeah, like I don't know how they get to, so let's look at it. So they're saying,
but the provision for restoration.
So yes, so the transmission plant is used in the day-to-day activities, and deferred tax therefore calculated using the correct rate. However, the provision was not calculated correctly, and therefore the temporary differences are incorrect. Okay, now the provisions were omitted from the deferred tax computation, and they should have been included in the deferred tax computation as follows. Like, I don't understand how come why. Deferred tax is a year-to-date balance, okay? So you can't take a difference. It needs to be the provision, because the provision is completely removed, right? It's not here at all. If I look at my balance sheet at 31 December 2019 would represent, you see my Excel, right? Would represent these amounts over here. This is my balance sheet.
Yes.
Each amount, my balance sheet would be that, right? The 7 million and the 3.5 million. It's not the movement. So that is what, for me, they're getting wrong over here. This can't be correct. This can't be correct. That is not the balance. At 31 December 2019, that is not the balance. That is the movement between the old and the new. Now, where is the old? The old is not here at all in the calculation. So therefore, they needed to bring in the entire balance. You get what I'm trying to say? So now, this is a question you must go back to your to the lecturers and ask them, how come we're only bringing in the movement and why not? Okay, we're slightly off over here. I'm not sure why we're off. There's no calculation given, so I don't know where we can see how we got the calculation wrong. But that's what you can go find out from your examiners. You understand? I don't know how they got to that. You understand? You get on where I'm coming at.
No, that we hear you, guys, because it means the whole balance, not the difference.
Yes, because what should have been for them to bring in the difference, there should have been a provision already in the calculation and the wrong provision, meaning the provision based on the original information based on the 10 and the 5. And then you adjust for the extra, whatever, 7 million. So yeah, so I mean, that is something you have to go to ask your lecturer and ask him, how come we only bringing in the difference? Where is the other part? Because if you're using a balance sheet approach, you need to bring in a balance as at 31 December 2019. The balance as at 31 December 2019 is that column in where I have new. Okay, so yeah, there's nothing, I can't go further than that. I can't explain further than that. So now let's just do the trade and other receivables. So trade and other receivables, here is at 6 million. So I'm just going to see my calculation over here. If I go to what's my difference. So here you can see they had the 6 million and they're saying the 6 million is related to a prepayment, which is correctly included in trade and other receivables, but is not included in tax base. Why? Because the accountant, what did the accountant do? He put it through in the 2019 tax return. But what we are saying is not actually correct, because the 6 million, you only get the deduction when it's actually incurred. You haven't incurred the expenses yet. So therefore, this 8 should include the 6 million, which means there will be no deferred tax deduct. There will be no temporary difference, and as a result, no deferred tax, implication. Do you understand what I'm saying over there?
Can you come again?
Okay. So what he did from an accounting perspective, he did the following. Okay, so if I'm going to just do it over here for the prepayment trade receivables. Okay, so prepayment trade receivable. From an accounting perspective, he did the following. He said prepayment and bank SFP. So I'm just showing you the journal entries so you can see what happened. So this is an accounting perspective. So he said 6 million. 6 million. 100% correct. Okay, so this is 100% correct. So his carrying amount is correct from an accounting perspective. So now from a SARS perspective, from an income tax perspective, okay, so that is correct. From an income tax perspective, this is what he did. He did the following. Okay. He said expense. So he took it through P&L. So what is he doing? From a tax perspective, he is saying he's expensing the 6 million. He's claiming the deduction in 2019. But that is not correct. I'm assuming from your income tax perspective as well, you can only claim an expense you can only claim a prepayment once you incur the expense. You haven't incurred the expense, so therefore you can't claim the expense. As a result, you should not have reduced your tax, the trade receivables from a SARS perspective. The trade receivables from a SARS perspective must also include the 6,000. So from a SARS perspective, it must also be 14,030, and as a result, you should there's no tax consequence. What he did, he said trade receivable from SARS perspective must not include the 6,000 because we are claiming the 6,000 when we pay it. But SARS don't work that way. For an expense, or I'm saying SARS, but I mean, I'm assuming from Zimbabwe tax law as well, you can't claim an expense when paid. You must claim an expense when you actually incur it. So because you paid it, he's saying, okay, let's claim the expense. But you haven't incurred the expense. I'm assuming Zimbabwe law will also say you can't get the deduction. You can only get the deduction when you actually benefit from the expense. That is
Yeah,
what
that's correct.
So therefore, this is incorrect. This must include the 6,000. As a result, there's no temporary difference. As a result, there'll be no deferred tax implication. Where we can go look at the solution. So the solution says, Mr. Musa was incorrect in having a resulting temporary difference from the prepayment. Zimra, what does Zimra stand? Zimbabwe Revenue Authorities.
Yes, Zimbabwe Revenue Authority.
So only allows a deduction to a taxpayer when the goods have been received. Therefore, there shouldn't be a temporary difference. Okay, so that's what we exactly said. So that's it. I think, Justin, you raised your hand.
All right. I think you have explained the point that I wanted to raise. Okay. Thank you.
Tao, any question from your side?
Not at the moment. Thank you.
Okay. Eddie?
Not at the moment. Thank you, Faiz.
Okay. Tinashi?
No questions from me.
Okay. Walter?
No questions all as well.
Okay. So are we okay?
I can interject, Faiz. Faiz, can I interject?
Sure.
Because we've spoken about the prepaid expense. What about if it's prepaid income is the same? Eh?
No, prepaid income is different. Oh, well, I don't know from your guys, but our like in South African tax law, like in our Income Tax Act, for an expense, they only give you the deduction when you incur the expense, when you receive the goods or services, when you benefit from the goods or services. From an income point of view, our SARS tax us the earlier of receiving the money or the earlier of earning the money. So remember, from an accounting perspective, you recognize revenue not when you receive, but you recognize revenue when you earn. So from our income tax, when it's a prepaid income, you will be taxed when you receive the money, even if you didn't provide the service yet. So they works different from an income perspective versus from an expense perspective. Okay, so I don't know if that is the same for your authorities.
I think for us, I think they do the same as the expense.
Oh, okay. Then you also what you call it. Now, but us it's earlier of receipt or accrual when it's from a revenue perspective.
Okay, I think I will recheck. I'll reconfirm again.
Okay,
so it makes sense.
Okay. So there's certain stuff that you obviously have to find out from your lecturers to see what's the thinking. Maybe we're missing something, you know, things like that. So then they would be able to explain. Then you can just like let me know. So I hope you enjoyed the lesson. I hope it was beneficial. I hope you learned. If you have any questions, you can let me know. We have one more lesson for FAC. So MAC is completely done. We have one more lesson for FAC. It's a bit risky to push it for tomorrow, because like I'm saying, we're currently in a period where load shedding happens, then there's no load shedding, then it happens, then nothing. So like, for example, load shedding is not happening up until 5 o'clock today. Then from 5, it's going to start again. So because I must see a class tomorrow, it's too risky to say, let's do the last class for FAC tomorrow. So let's rather do it today. But we need to have it done before 5. But I don't know what's happening. When 5 o'clock happens, I'm not sure when is, and I'll have to check when is load shedding in my area. So are you okay with having it a little bit later today?
Yes, we are.
Or I think the 8th, I think, right? So we have to have it done before the 8th.
So you said it's FAC, right?
So load shedding starts at 5. I don't know which time it starts here by me. So the load shedding in South Africa will start from 5 o'clock, but each area have a different time. So I'll have to check. So what I want to do, I want to be done before 5 o'clock so that I know I'm safe from any load shedding and doesn't impact any classes. You understand?
So sorry, Faiz, you said it's MAC or a FAC?
FAC.
Okay.
Because we did our 4 math classes. We now have one more FAC. This is our 3rd FAC class. So I have one more FAC remaining. But I mean, you can decide which one you want to use it for. I'm just saying it is a FAC class. You can decide amongst yourselves if you want it to be FAC or you want it to be MAC. I'm easy on it.
All right. Tim, do you want us to continue FAC or want us to do MAC?
So you guys can decide on the group. You guys let me know. We'll probably start for the latest by 3, so we can end about 4:30, 5 o'clock. Okay.
All right. Then a quick one, Faiz, maybe the team will contribute. So the last time we discussed the issue to do with IFRS 9, I think it was the calculation to do with the liability, recognizing the liability. I think there was an issue to do with the standard. So I also went through the standard on how to determine the liability component. So I think the issue was we need to calculate the future value, assuming there was no conversion option. So I'm still a bit confused on that part, because to me it seems as if the standard was saying you calculate the liability portion, maybe the interest part as if there is no conversion option, but I'm not sure about the future value now, because on that particular question we did with, I think that there was an amount on the future value which is about 2 million, but the solution was saying the future value has to be 0, something like that. So I'm still worried, is it the interest or is the future value that we are, or is both?
I can't remember, to be honest, I can't remember. I know what you're talking about. I can't remember. Can you in the group, if you can just send me the details, and then I'll read through it, and then I'll provide you with an answer. But I'll give you a more solid answer when we rejoin at about 3:30. That's fine.
All right. All right, no problem. But I think the scenario was there were 2 interest rates. So we were taking into consideration the interest rate where there is no conversion option, because it was actually given that, you know, this is the market rate or interest rate when there is no conversion option. But then that one, I don't think it's a problem, because it is actually given. So the principle is then you have to go back to to IFRS 9, that you use the interest rate where there is no conversion option. But now my worry is, what about the future value? Am I taking the future value in the same context that there will be no conversion option, or the future value? My issue is on the future value. I don't know if you are getting me there. Am I using the lump sum figure in the future?
I know what you're saying, yes. I know what you're talking. Yeah. Let me just read up on it, and then I will get back to you on it. Okay. I know what you're talking. I know what you're confused about. So let me read up on it, and I'll get back to you. I'll get back to you at in our next session. Okay.
All right. Thank you very much, Faiz.
Any other questions? Nothing. Okay, so I hope you guys found the session beneficial. So I'll see you in about 2 hours or so, and then we will do the last session. Just confirm with me before 3 o'clock which one you want. Okay. But I hope you guys found the class beneficial. All the best for studying, but I'll see you in a bit. Okay, bye-bye.
Thank you.
Bye.
Thank you.
Thank you.
Yes.